Ever wondered how investing in mutual funds work? Well, let's break it down. A mutual fund at its core is an investment vehicle, but not just any vehicle, it's a high-octane, power-packed machine that carries a portfolio of stocks, bonds, or other securities. Picture this. You're an individual investor. Maybe you've got a little extra cash on the side that you'd like to see grow. But the world of investing can seem like an intimidating maze. That's where mutual funds come in. They give you, the small investor, access to professionally managed, diversified portfolios. And the best part? It's all available at a surprisingly low price. It's like getting a VIP pass to a world-class concert without burning a hole in your pocket. So, what's the bottom line? Mutual funds are a practical, cost-efficient way to build a diversified portfolio of stocks, bonds, or short-term investments. And this, my friends, is just the beginning. Buckle up, we're just getting started. Now that you know what a mutual fund is, you might be wondering, how does it work? Well, at its core, a mutual fund is a pool of money contributed by multiple investors. Each investor buys shares, which represent a portion of the holdings of the fund. The beauty of mutual funds lies in this pooling of resources. It allows individual investors to access a diverse range of investments, which they might not be able to afford or manage on their own. Imagine a pie, a really big and delicious one, filled with a variety of ingredients: apples, cherries, blueberries, and so on. Now, each slice of this pie represents a different type of investment: stocks, bonds, or other securities. When you invest in a mutual fund, you're essentially buying a slice of this pie. You get a taste of everything without having to buy each ingredient separately, and just like any pie, the whole is usually worth more than the sum of its parts. This is due to the magic of diversification, which helps to spread risk. So, even if one investment doesn't perform well, the others might still do well, balancing the overall performance of your slice of the pie. Now let's talk about the value of this pie, or rather, your slice of it. This is represented by the net asset value, or NAV. The NAV is calculated daily by taking the total value of all the securities in the portfolio, subtracting any liabilities, and dividing by the total number of outstanding shares. It's like taking the total value of the pie, deducting any costs, and then dividing by the number of slices. The NAV gives you the per-share price of the fund on any given day. So, to sum it up, when you buy into a mutual fund, you're pooling your money with other investors to purchase a diversified set of securities. Your share of this investment is represented by the NAV. In essence, when you buy a mutual fund, you are buying a piece of a large and diversified investment pie. So, you're interested in investing in mutual funds, but where do you start? First things first, you'll want to do your homework. Like any investment, mutual funds come in many shapes and sizes, each with its own set of benefits and risks. Some funds focus on stocks, others on bonds, and some blend the two. You'll also find funds that invest in real estate, commodities, or international markets. The key is to understand what you're investing in. Once you've got a handle on the different types of funds, the next step is to align your choice with your risk tolerance and investment goals. Are you a risk taker, willing to ride the highs and lows of the market for potentially greater returns? Or are you more conservative, preferring steady growth and minimal risk? And what are your investment goals? Are you saving for retirement, a down payment on a house, your child's education, or something else entirely? Answering these questions will help you narrow down your options and choose the right fund for you. Now that you've chosen your fund, it's time to buy shares. You can do this through a broker or directly from the fund company. If you're using a broker, they'll guide you through the process and handle the transaction on your behalf. If you're buying directly from the fund company, you'll need to open an account, fill out some paperwork, and send in your investment. The number of shares you'll get depends on the amount you invest and the current price of the shares. After you've made your investment, don't just set it and forget it. Mutual funds are not a one-and-done deal. It's important to monitor your investment, check in on its performance, and adjust your strategy as needed. This doesn't mean you need to watch the stock market every day, but you should review your investment at least once a year. Remember, investing in mutual funds is not about getting rich quick. It's about growing your wealth steadily over time. So let's summarize what we've learned today about investing in mutual funds. Firstly, we delved into what a mutual fund is. We learned that it's a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities, which multiple investors pool their money to buy. Remember, each investor in the fund owns shares, which represent a portion of the holdings. Next, we discussed how mutual funds work. We found out that when you buy a mutual fund, you're purchasing shares of the total fund, not individual securities. The value of your shares goes up or down based on the performance of the securities in the fund's portfolio. We also learned that mutual funds are managed by professional money managers who make the investment decisions. Then we moved on to how to invest in mutual funds. We learned that you can buy mutual fund shares directly from the fund company or through a broker. We also learned about dollar cost averaging, a strategy where you invest a fixed amount of money at regular intervals, regardless of the fund's share price. This approach can help mitigate the impact of market volatility. We also highlighted the benefits of investing in mutual funds. Diversification is a key advantage, as it allows you to invest in a broad range of securities in one go, reducing the risk of any single investment. Another benefit is the professional management of your investment. Mutual fund managers are seasoned professionals who have the expertise and resources to research and select investments. But we also stress the need for due diligence. It's crucial to understand the mutual fund's investment strategy, its risks, and its costs before you invest. And always remember that, like all investments, mutual funds come with risks, and it's possible to lose money. Investing in mutual funds can be a powerful tool for growing your wealth, but as with any investment, it's important to do your research and understand what you're buying before you invest.